Hey investors, welcome to my channel, where we turn complex financial reports into actionable insights. In this video, I will walk you through companies' key business metrics, analyze their growth trajectory, and break down their financial performance in simple, clear terms. So let's get started. Tata Consultancy Services, or TCS, is a technology company that provides IT services, consulting, and business solutions. The company operates in 54 countries. TCS has over 601,000 consultants. In the past 3 months, there has been a decrease of 4.15% in the stock. Tata Consultancy Services operates through 6 primary segments. These are banking, financial services and insurance, life sciences and healthcare, manufacturing, communications, media and information services, AI and cloud, and enterprise solutions. Let's break down what each of these segments does. The banking, financial services, and insurance segment provides IT and consulting services to companies in these sectors. This involves helping them become more efficient and offer more personalized services. The life sciences and healthcare segment offers technological solutions to pharmaceutical and healthcare organizations. This segment aids in accelerating drug development and enabling remote patient care. The manufacturing segment focuses on services for manufacturing industries. They assist with improving efficiency, productivity, and sustainability. The communications, media, and information services segment upgrades communication infrastructure, including 5G and 6G technologies, to support digital service providers. The AI and cloud segment provides AI and cloud-based services. It helps organizations adopt AI to improve efficiency and drive innovation. Finally, the Enterprise Solutions segment offers solutions designed to create business value and competitive advantage for clients through services like cloud migration and data analytics. Now, let's look at the shareholder returns of this company. This year, the company recorded a return of 9.11%, falling short of the industry average of 11.4%, but performing better than the market's 8.83%. This indicates a strong footing in broader market trends, though there's an opportunity to close the gap with industry leaders. Let's examine the company's revenue challenges. Revenue declined by 0.45%. Looking at the quarterly trend from Q2 2023 to Q3 2024, revenue increased from 600 billion INR to 639.7 billion INR. Showing a fluctuating but overall positive trend. The data is not available for this script. The company shows strong cost management capabilities. Gross margin stands at 38.29%. Since Q2 2023, this number has fluctuated from 40.39% to 57.97% in Q4 2023, then returning to 37 to 38% range, showing a sharp increase followed by a decline. Operational efficiency shows notable improvement. Operating margin is at 24.47%. The trend from Q2 2023 to Q3 2024 shows an initial increase from 24.26% to a peak of 26.18% in Q4 2023, before declining, and then stabilizing around 24%. Profitability shows positive momentum. Net margin is 19.35%. Over the past 5 quarters, we've seen fluctuation from 19% in Q2 2023, then dipped before peaking at 20.30% in Q4 2023, then stabilizing around 19%, representing a fluctuating but overall positive trend. The company maintains healthy liquidity levels. Current ratio stands at 2.6. Looking at the quarterly trend from Q1 2023 to Q2 2024, we've seen fluctuations, with an initial increase followed by a slight decrease and ending near the previous high. The current ratio tells us how easily a company can pay its short-term bills. Think of it as having $2 in your checking account for every dollar you need to pay this month. Generally, a ratio above 2 is considered strong, showing the company has ample resources to meet its short-term obligations. The company maintains a conservative debt profile. Debt-to-equity ratio is 0.5. From Q1 2023 to Q2 2024, this ratio has fluctuated, initially decreasing before increasing and then decreasing again, indicating some variability in the company's leverage. This ratio is like comparing your mortgage to your home equity. A lower ratio means less financial risk. Generally, a ratio below 0.5 is considered comfortable, though this varies by industry. The company demonstrates robust debt servicing capability. Interest coverage ratio is 72.2 times. The quarterly trend from Q2 2023 to Q3 2024 shows considerable volatility, with an initial decrease, followed by an increase, and then a decrease again, suggesting some instability in the company's ability to cover its interest expenses. Think of this as how many times over the company can pay its interest bills, like having $9 available for every dollar of interest payment. A ratio above 5 typically indicates strong financial health. The company delivers solid returns to shareholders. Return on equity stands at 46.8%. This measures how efficiently the company uses shareholder money. Think of it as the return on investment for company owners. Generally, a return above 15% is considered attractive to investors. The company shows reasonable cash reserves. Cash to total assets ratio is 5.1%. From Q1 2023 to Q2 2024, we've seen fluctuations, with an initial decrease followed by a slight increase and then a decrease, suggesting the company's cash management has varied. This ratio tells us how much of the company's resources are in readily available cash, like having emergency savings in your bank account. Generally, a ratio above 15% indicates strong liquidity. Now, let us analyze how this company is performing when compared to its peer. The company's price-to-earnings ratio is 30, while their competitors are averaging around 30. In simple terms, you're paying 30 rupees for every 1 rupee of company's earnings, compared to 30 rupees you'd need to pay for the same earnings at their competitors. This lower valuation suggests you might be getting better value for your investment compared to its peers in the market right now, though it's worth investigating why the market has assigned this lower valuation. The company's price-to-sales ratio is 5.86, while their competitors are averaging around 4.25. What does this mean? You're paying 5.86 rupees for every 1 rupee of company's sales revenue, compared to 4.25 rupees for competitors. This higher valuation suggests the market expects superior sales efficiency or growth potential, though you're paying a premium for each rupee of current sales. The company's enterprise value to EBITDA ratio is 19, compared to the industry average of 18. In simpler terms, this higher ratio indicates the market is placing a premium on the company's business value relative to its operating performance. While this might reflect expectations of stronger future performance, it also means you're paying more for the company's current operational efficiency. Now, let's break down what analysts are expecting over the next 2 years. According to analysts, the company is expected to show earnings per share of 136 rupees in 2025, growing to 151 rupees in 2026, representing a 10% growth. For context, in Indian markets, a growth company typically shows earnings growth above 15 to 20% annually, while mature companies usually grow between 8 to 12% per year. Looking at revenue estimates, analysts project 10% growth. Generally, growth companies in India should show revenue growth of at least 15 to 20% annually, while mature companies typically grow revenue at 7 to 12% per year. The company is focusing on several key strategic initiatives. One is expanding agentic AI adoption, moving beyond basic applications to orchestrate transactions within business value chains. This involves leveraging the company's contextual knowledge to solve high-value business problems for clients. Technology modernization is another priority, specifically SAP S/4HANA transformations, cloud engagements, building data foundations for AI, and cybersecurity. These areas are seeing strong investment from clients. Additionally, the company is focusing on AI adoption in the BFSI sector, noting an increase in successful production deployments of AI and Gen AI, which leads to greater business certainty and confidence for clients. Another key area involves expanding into new markets by localizing omnichannel experiences. This means adapting their knowledge for local languages, currencies, payment preferences, and compliance regulations to ensure a unified user experience. Finally, the company aims to drive on-platform growth through government skilling initiatives, leveraging the Indian government's focus on industry participation in employability, internships, and skilling. The company's capital allocation priorities include returning free cash flow through dividends, the board recommended a dividend of 76 rupees per share, including an interim dividend of 10 rupees and a special dividend of 66 rupees per share. Another priority is investing in talent development. The company continues to invest in skill development, and employees logged over 40 million learning hours year-to-date, acquiring 3.8 million competencies. The company is also increasing campus hiring, gearing up to onboard a greater number of campus hires in the coming year. These initiatives ensure preparedness to meet client needs and drive long-term organizational success. Furthermore, there are strategic investments in talent, global delivery centers, paceports, and partnerships to drive long-term sustainable growth in growth markets. Lastly, investment is being directed towards AI technology through a partnership with a leading global semiconductor major. This involves co-creating foundational AI technology, including multi-core server CPUs, GPU, SoCs, and AI-based systems. The company's execution track record includes the successful completion of Zions Bancorporation's Future Core project. This involved a large-scale core banking modernization with TCS NCS, enabling real-time transaction processing and delivering an exceptional customer experience. Additionally, the company successfully migrated 3 million UK life and pensions customers to TCS NCS for Scottish widows, comprising over 500 products. Another accomplishment includes improved fraud detection for a leading global bank. An innovative predictive AI solution that performed real-time transaction monitoring, detects customer behavior anomalies, and generates risk scores with an 18 percentage point improvement in fraud detection, reduced false positives by 25%, and improved fraud analysis response times by 50%. The company also digitized device history records and transformed plan operations for a global medical technology company, partnering with TCS. Finally, the company managed over 17 million assessment candidates via TCS ION. The assessment platform was used for administering in-center exams for over 17 million candidates. The company expects similar client IT budgets in calendar year 2025 with a positive bias, suggesting a stable demand environment with potential upside. Early signs of revival are noted in discretionary spending within the BFSI and retail sectors, indicating potential revenue growth. Additionally, manufacturing and life sciences healthcare are expected to start seeing growth in the medium term, suggesting future growth potential after near-term challenges have bottomed out. The management reiterates its margin aspirations for the fourth quarter, targeting 26 to 28%, showcasing a focus on profitability alongside revenue growth. Furthermore, the company expects stronger international growth, with regional markets like India, Middle East, Latin America, and Asia Pacific driving growth. Finally, the BSNL ramp down is starting in the fourth quarter itself, but is expected to extend to a maximum of the second quarter. So, what do you think about this company's future prospects? Would you consider investing in this company? I'd love to hear your thoughts in the comments below. If you found this breakdown helpful, please take a moment to like this and subscribe to the channel. It's completely free, and your support motivates me to create more in-depth analyses every day. Thanks for watching, and I'll see you in the next video where we'll dive deep into another exciting company.